FOMO and finance, how social media affects your investments. The fear of missing out, FOMO, has become a significant psychological driver in the modern digital age, especially in finance and investing. Social media platforms have amplified this effect, with information, speculation, and trends rapidly influencing investment decisions. Here's how social media impacts investments and the role FOMO plays in this dynamic. 1. The psychology of FOMO in investing. FOMO is the fear that others are gaining something that you're not, often seen in situations where people feel left out of a hot investment opportunity. This fear can compel individuals to make rash decisions, motivated by emotions rather than rational analysis. Investors driven by FOMO tend to chase trends. They buy into assets that are hyped on social media, often at their peak, in fear of missing potential gains. Neglect due diligence. Instead of researching companies or market conditions, FOMO-driven investors rely on what they see trending online. Overextend. Investors may invest more than they can afford, fearing they'll miss out on large profits. 2. The role of social media. Social media platforms like Twitter, Reddit, YouTube, and TikTok have transformed how people gather information about investments. Here's how these platforms impact investors. Instant access to information. Social media provides real-time news, updates, and analysis. However, the speed at which information spreads often outpaces investors' ability to critically assess its validity. Influencer culture. Financial influencers or finfluencers offer stock tips, crypto insights, and investment advice. While some are credible, many provide advice without professional backing, pushing followers into risky investments based on their personal opinions. Viral trends and hype. Social media platforms can send stocks or cryptocurrencies soaring based on viral trends. Examples include meme stocks like GameStop, $GME, or Dogecoin, $Doge, where a large online community rallies behind an asset, pushing prices to unsustainable levels. Echo chambers. Algorithms on social media often show users content that aligns with their existing beliefs. This creates echo chambers where investors may only see information that confirms their biases, leading to poor decision-making based on incomplete data. 3. Examples of social media-driven investment phenomena. Several key events highlight how social media influences investments. The GameStop short squeeze. In January 2021, a Reddit community called r Wall Street Bets coordinated a massive short squeeze on GameStop stock. As momentum built, FOMO kicked in, with thousands of small investors jumping in due to the fear of missing out on massive gains. The stock soared from $20 to over $400, driven largely by social media, before eventually collapsing. Cryptocurrency hype. Bitcoin, Ethereum, and various altcoins have seen their prices skyrocket due to hype on social media. Dogecoin, a cryptocurrency originally created as a joke, surged over 12,000% in 2021 after being endorsed by celebrities and gaining traction on Twitter and Reddit. NFTs, non-fungible tokens. The NFT market experienced a massive boom in 2021, largely driven by social media influencers and digital communities. Many investors bought into NFTs due to fear of missing out on the next big thing in digital assets, often paying exorbitant prices for digital art and collectibles. 4. FOMO's financial consequences. While FOMO can lead to profitable opportunities, it often results in significant financial losses for the average investor. Buying high, selling low. FOMO-driven investors often buy into assets at their peak price when social media hype is at its highest. As a result, they may sell out at a loss when the market corrects or the bubble bursts. Increased volatility. Social media hype can exacerbate market volatility. Assets influenced by online buzz often experience extreme price swings, making it difficult to invest with a long-term strategy in mind. Emotional stress. Constantly following the ups and downs of social media-fueled investments can take a psychological toll, leading to poor decision-making and burnout. 5. Mitigating FOMO's impact. To avoid falling into the FOMO trap, investors can take several steps. Diversify. Diversification helps reduce risk. Rather than chasing the next hot stock or asset, spread your investments across various sectors, geographies, and asset classes. Do your own research, DIY. Relying on social media influencers or viral trends for investment decisions is risky. Always do your own research and critically assess whether an asset is worth investing in based on fundamentals. Have a long-term strategy. Social media can tempt you to make short-term trades. It's important to establish a long-term investment strategy based on your financial goals rather than short-lived trends. Limit social media exposure. Reducing your time on social media platforms can help avoid being swept up by the hype. Set limits for checking investment-related posts and be mindful of the sources you trust. Conclusion. Social media is a double-edged sword in the world of finance. While it democratizes access to information and opportunities, it also fuels FOMO, which can lead to impulsive and irrational investment decisions. By understanding the psychological effects of FOMO and taking steps to mitigate its impact, investors can navigate social media-driven markets more effectively and avoid costly mistakes.